My suspicion is over the next 10 years, the purchasing power of the US dollar declines by 75%. In the 1970s, when we devalued the US dollar by 75%, the gold price ran 30-fold. I'm not suggesting to you that gold runs 30-fold from here, but I am suggesting to you that there is a probability that gold's rise keeps pace with the decline in purchasing power of the US dollar. That's a pretty attractive proposition.
Back in 2023, many investors were asking when gold would finally move. Those who bought simply because gold seemed oversold and hoped for a quick rebound may have seen enough gains to exit. But for seasoned investors like RickRule of Rule Investment Media, that kind of thinking misses the point. Rule says he holds gold not for short-term gains, but because he understands history. Gold has consistently protected purchasing power when fiat currencies come under pressure. In his view, that concern is only just beginning to emerge. Gold prices rose over 1% on Tuesday, supported by a weakening US dollar and growing economic uncertainty ahead of President Donald Trump's July 9th deadline for reintroducing higher trade tariffs. The dollar has had its worst start to a year since 1973, with the dollar index falling 10.8% in the first half of 2025. Trump's erratic tariff policy and his repeated criticism of the Federal Reserve have raised questions about the central bank's independence and damaged the dollar's safe haven status. Adding to the pressure is the ongoing debate in Congress over Trump's proposed Big, Beautiful tax bill, which is expected to increase the U.S. national debt significantly over the next decade. Concerns about fiscal sustainability have led to a sharp pullback from the U.S. Treasury market as investors seek alternative investments to protect their capital. Amid this backdrop, gold has continued to post record highs in 2025, mainly driven by central bank demand. Many institutions are increasingly worried about the devaluation of their dollar reserves and are turning to gold as a hedge. RickRule draws a comparison to the 1970s, when a collapsing dollar led to a 30-fold increase in the price of gold. While he isn't predicting another 30x move, he believes gold will at least keep pace with the dollar's ongoing decline, an outcome that, in his view, is more than enough reason to own it. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
You and I might remember conversations we had in 2023 when people are saying, when's gold going to move? Those people who were buying gold because it was oversold and it would come back should sell. You know, if you owned gold for trade, you got your trade. Kiss it, move on. That's not why I own gold. I own gold because I have a sense of history. I own gold because gold has done well when people are concerned about the maintenance of their purchasing power in fiat-denominated instruments. And I think that fear is just getting started. I can't talk to you about Australian math, but let me give you some American math. The on-balance sheet liabilities of the U.S. government exceed 36 U.S. dollars, not Australian dollars, U.S. dollars. But the off-balance sheet liabilities are even worse. What are off-balance sheet liabilities? They're old guys like me. Medicare, Medicaid, Social Security, federal government pensions, military pensions. That number, the net present value of that number, is $100 trillion. The American Internal Revenue Service estimates that the private net worth of Americans is $141 trillion, and our government owes 130 of it. This is a lousy number, Shay. I mean, this is a really lousy number. I believe that we deal with that debt rather than honestly by defaulting dishonestly. In particular, I think that we do what we did in the 1970s, which is to say that we devalue the purchasing power of the US dollar. You honor the nominal value of the obligation. You say to some old kook, RickRule, we promised you $4,000 a month in Social Security, and you're going to get it. But we're going to devalue the dollar so that the $4,000 buys you $1,000 worth of goods and services. In the 1970s, according to the Congressional Budget Office, the US dollar lost 75% of its purchasing power. That's how we dealt with the debt built up by the war in Vietnam, which, by the way, we lost, and the war on poverty, which, by the way, we lost. My suspicion is over the next 10 years, the purchasing power of the US dollar declines by 75%. In the 1970s, when we devalued the US dollar by 75%, the gold price ran 30-fold. I'm not suggesting to you that gold runs 30-fold from here, but I am suggesting to you that there is a probability that gold's rise keeps pace with the decline in purchasing power of the US dollar. That's a pretty attractive proposition. People ask me, well, Rick, you've been bullish on gold for at least 5 years. What would make you sell? That one's easy too. If the reason to own something goes away, the thing has to go away. So they would need to balance the US budget. They would need to have positive interest rates in the US. By positive interest rates, I mean that the interest on the US 10-year Treasury would have to be larger than the deterioration in the purchasing power of the US dollar. And they would have to have a fiscal plan in place to deal with $100 trillion in the net present value of government liabilities. I suspect 10 or 12 years from now we'll get there. But I don't suspect in 2 or 3 years that we'll get there. And I'll give you one more piece of really cool math. JP Morgan Chase suggests that the market share of precious metals and precious metals related assets relative to other asset classes in the US savings and investment market is 1/2 of 1%, which is to say, if you look at every investment and savings asset class in the United States, only 1/2 of 1% of our total portfolio is denominated in precious metals. JP Morgan Chase says that the 4-decade mean market share is 2%. If negative real interest rates and debts and deficits begin to concern people the way they concerned people in 1971, 1972, if gold was to return to mean, that would give you a 4-fold increase in demand. I can't tell you what that would do to price, but I can tell you that the number is much likely to be higher. So I am and remain a gold bug. The most important mistake is most investors that I know get the long-term strategy right, but their tactics are short-term. Somebody believes that gold is going to do well over 5 years, but their anticipated holding is over the next long weekend. If you don't synchronize your expectation to the time that it will take for your expectation to play out, you're going to lose. Long-term strategy with short-term tactics does not intersect. You know, the great American mutual fund group, Fidelity, with millions of investors, looked at their whole investor database and they stratified them by various factors. You know, zip code, net worth, race, gender, age, all this kind of stuff to try to figure out how to market to various groups, but also to try to figure out what various groups did right and did wrong. The subgroup that they came up with that outperformed every other investment class, estates outperformed other investors because estates didn't trade. They didn't go from hot sector to hot sector. It teaches us a lot. If dead people can outperform active money managers, it tells you a lot about the right holding period for good investments.
That was not what I expected the hot take of today's interview to be, by the way.
Well, you know, Shay, I'm 72 years of age. The affairs of dead people are becoming of more interest to me.
RickRule believes the current phase of the gold bull market is favoring the strongest players in the sector. The largest and most established gold mining companies are currently outperforming, but he says it won't be long before the rest of the industry catches up. According to Rule, a primary bull market is already underway, and if historical patterns hold, it could be an advantageous period for those who are positioned early. For the first time in 6 years, gold mining stocks are set to outperform physical gold. Investors in exchange-traded funds are already using the rally to lock in gains. The VanEck Gold Miners ETF has surged 50% so far this year, more than double the 25% return of the SPDR Gold Trust, which tracks physical bullion. If this trend holds through the end of 2025, it would mark the first year since 2019 that GDX has outpaced GLD on a calendar year basis. That year, GDX gained nearly 40% compared to GLD's 18% return. The rally has pushed GDX to its highest level in more than 13 years. Its top holdings include major producers such as Newmont Corporation, Agnico Eagle Mines Limited, and Wheaton Precious Metals Corporation. Despite this impressive performance, GDX is still about 24% below its 2011 peak. However, the gap narrows to around 13% when accounting for dividends. Interestingly, despite the surge in price, investors have withdrawn $3.4 billion from the fund this year, likely taking profits while valuations are elevated. Even so, GDX remains one of the most popular vehicles for gold exposure, with $15 billion in assets under management. The continued strength of gold mining stocks, combined with a bullish outlook for precious metals, suggests the current market may only be in the early innings of a broader revaluation cycle. Let's get back to the interview.
The junior market as a whole, worldwide, deserves to be a wreck. If you merged every junior in the world, all 3,000 of them, you know, the Australians, the Canadians, the stuff from AIM, the US over-the-counter crap, if you merged them all into one company, Junior Explorer Co., that company in a good year would lose $2 billion. Expenditures over M&A, stuff like that. In a bad year, which perversely they would call a good year because they could raise money, they'd lose $10 billion. So your viewers need to ask yourself, what would you pay for this company? Would you pay 8 times losses? Would you pay 12 times losses? In a bull market, would you pay 15 times losses? The junior sector as a whole worldwide is valueless. 85% of the listings worldwide, including the Australian listing, aren't worth the paper that they're printed on, assuming that they're printed on paper. That belies the fact that 5, 10, sometimes 15% of the juniors generate such exquisite value that they add legitimacy and even luster to the sector. And that subset of high quality juniors is going to absolutely rip. We're going to see a bull market that's reminiscent of the bull market that we enjoyed in the early part of the decade of the 90s. You weren't there, Shay, but take it from me. It was a lot of fun. Bull markets follow predictable patterns. The market is led by the commodity. We saw that in 2023 in gold. Gold led, but the gold stocks went nowhere. That's easy to understand. The buyers were foreign central banks and they don't buy shares, right? So the asset class that had a buyer went up and the asset class that didn't have a buyer didn't go up. Surprise, surprise. But that follows an age-old pattern because gold bull markets are led by fear buyers and fear buyers don't buy stock. They buy the gold. Two things happen when gold itself establishes the momentum. The first is that the momentum of gold reinforces the gold narrative and makes the whole sector around gold more interesting. The second thing that happens is that the increase in gold price, once it gets underway, is faster than the increase in the input cost to produce the gold. So the biggest and the best producers, the seniors, start to deliver absolutely blowout earnings, which is what we saw in 2024 in the gold sector. Gold mining company managements exceeded even their own optimistic performances about their quarters. The investors were newly conditioned to that by the increase in the gold price. So we saw just 15 weeks ago investor interest, retail investor interest, storm back into the gold ETFs after having been absent for 3 years. This has happened in every bull market of my life. When that happens, the senior producers, the largest, the most liquid, the highest quality producers, develop valuation disparities. They get the buyers, and in particular, they get the index and passive buyers. And so their share prices relative to their net asset values grow, while the best of the rest, the other producers, don't participate. Then one of two things happens. The relative value guys, the RickRules of the world, say, well, this class is cheaper than this class that's already moved. So I got to shift some of my dough from up here to down here. If that doesn't happen, the big guys take over the little guys because their cost of capital is lower. This is simple stuff. After that happened, the single asset producers and the best of the rest move for the same reason, valuation discrepancies. And then finally, the juniors and developers move. These follow predictable patterns. This will happen again. There is a bull market coming to a sector near you. In fact, we're in it. I don't think that we're in an industrial materials bull market yet. I think that market is hampered by the specter, perhaps real, of a worldwide recession. I wouldn't look for relief in nickel or copper or oil and gas in the near term, but that'll come too. Make no mistake, we're in a go bull market. I've seen these before. And visualize this bull market, Shay, as a circus master's whip. The handle of the whip, the front of the whip moves first. That's gold. That has to precede. The next thing that goes past the circus master's shoulder are the Franco-Nevadas, the biggest, the highest quality companies in the world. They move next, pulled by gold. Then the best of the rest move. Then the developers move. Then the penny dreadfuls move. This follows a predictable pattern. With each stage of the whip, when they move faster and they move further. But the whip moves qualitatively. We're now in the part of the whip that favors the Wheaton Precious, the Franco-Nevadas, the Agnico Eagles, those guys, the best of the best. But the move will come very quickly to the best of the rest.
Longtime observers of monetary cycles will recognize the familiar signs. Fiscal expansion, political unpredictability, and a weakening reserve currency are again setting the stage for a strategic pivot toward tangible assets. While some investors have already booked gains from this year's rapid ascent in gold and mining equities, others see these developments not as an end, but as a prologue. Market momentum, central bank accumulation, and a fractured macro environment are converging, pointing to more profound shifts in capital preservation strategies. As the next phase unfolds, the real question may not be how high prices can go, but how long current levels will remain accessible. Is the current consolidation in gold and mining stocks a pause before a much larger repricing, or has the market already priced in the major catalysts? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.